Hi, my name is Roy Gumbo, and I'm an accounting professor at the University of North Texas. I teach intermediate accounting 1 and 2. And today I will be talking about long-term assets. The last chapter on long-term assets discussed acquisition of those assets. And today we're going to talk about what happens after you buy them. How are we going to record the benefit for those assets as an expense? And then what happens if their fair value drops or if we dispose of those assets? So a lot of different topics today. And for my UNT students, this is the last chapter for Accounting 1, Intermediate Accounting 1. And so time for summer after this, if this is in the spring semester. Although these videos are going to be on YouTube and be available to future classes as well. And so with that, I'm going to get started. I do want to give credit to McGraw-Hill and their Spiceland, Nelson, and Thomas textbook called Intermediate Accounting. It's a great textbook, highly recommend it. And with that, I'm going to get started here. So again, we're going to talk about really three types of two types of long-term assets: property, plant, and equipment, and intangible assets. And we're going to talk about the use of those assets, and then what happens when we dispose of those assets. And so it comes up with a lot. And a lot of this you may have seen in your principles of accounting class. Obviously, here we go a little deeper into this. And so a long-term asset is an asset that we're going to hold longer than 1 year. And many of these could be used, if it's a factory, that could be used for 20, 30, 40 years. And so we got to record the use of that asset as an expense over time. And so because we are an accrual-based accounting, if we spend 400 million for a big factory, we don't expense 400 million in the year we pay cash for that. We expense it over the use of that. And we have to find a way to allocate that cost for 400 million in that example over the number of years we're going to use that asset. So we have to make some assumptions up front. Now, we're going to talk about, again, three types of property, plant, and equipment. Really not property, because that would be land that's not depreciated, I guess. Natural resources, timber, oil and gas. Here we're in Texas, we're going to talk about oil and gas, our favorite subject around here. And so the cost, as you already know, for plant and equipment is called depreciation. And we have accumulated depreciation. I think you already got that at this point of your intermediate accounting journey. However, for natural resources, it's the same type of cost, except we call it depletion. So just a name change there. Don't be confused. It's like depreciation. We're going to record a depletion expense as we extract those natural resources and prepare them for use. And then for intangible assets, we have what's called amortization. Again, really the same thing as depreciation, just a different name, if you will. So you're going to think along the same lines. We'll talk about each of these subjects. And so how do we allocate this cost? Here's an example where we buy a used truck for $8,200. Obviously, must be used at that price. And we know at the end of its service life, again, we're going to talk more about this, but the physical life of this truck may be way out there, maybe 10 years. But in our business, we know that after 5 years, it's not useful for us anymore. And so we'll be able to sell it and someone else could use it. And we're going to estimate now, day one of this purchase, how much we think we might be able to sell it for in 5 years. That's obviously hard. Many people just put zero there. But here we think, based on history, that we'll sell this for $2,200. So our real cost of this truck is what we paid up front minus what we'll get back later. So that would be the $8,200 purchase price minus what we call the residual value, $2,200. So the real cost of the business is $6,000, and we're going to use it over 5 years. So we got to find a way to allocate this $6,000 to each of these years over 5 years. And there are multiple, we always make it a little hard in this area. there are definitely multiple ways of doing this. So as we think about this cost allocation, we've got to think about three things here. One, the service life. Again, different than the physical life. The service life is how long that asset will be useful for us. And sometimes in this chapter, you'll hear the term useful life, service life, useful life, they're synonymous. Don't be confused by those. And many times I will say useful life, because I'm used to saying useful life versus service life. So synonymous terms, don't get caught up in that. And so the allocation base is the cost of the asset that's going to be consumed. In our previous example, it would have been the $6,000, the $8,200 purchase price minus the $2,200 that we're going to get back later, the residual value. So the allocation base is that $6,000 that asset's going to cost us over what period? The service life. And then allocation method, we're going to have to pick an allocation method, and we're going to allocate these costs in a very systematic and rational manner. Those are an important choice of words there. You could see that in a multiple choice question if you're in my class. And so there are various allowed allocation methods in GAAP in order to record that cost. So the service life is just, how long we expect to be able to get benefits from that asset until the end. Now, it could be years, it's going to be more than a year because it's a long-term asset. So it's not going to be months. It's going to be years expressed in time, or it could be just activity. Let's say we buy a truck and we don't know if it's going to be 3 years, 5 years, 7 years, but we know, hey, after 100,000 miles, it's not good anymore. And I usually personally keep my cars, and I start thinking about trade-ins when I hit 100,000 because I know repair and maintenance is going to go up at that time. Same thing for companies. And so they may look at the used service life as some activity-based measure like miles driven or units produced by a factory machine, and the same concept that you might use personally, businesses will use. So that service life, again, time or activity. So, the service life is never going to be longer than the physical life, right? So you got to, think through this. What's the real physical life of this, service life? Well, then wonder how long are we going to use it? And that would be the service life. So physical life will vary, according, will be different than the service life. And generally, service life for businesses is, less than the physical life. Why? Some of the reasons here. Hey, technological change. Maybe trucks are being developed with far more efficiency in terms of miles per gallon. And so we may want to, trade these trucks in every 3, 4, 5 years in order to get a newer truck with better technology and save us money, especially computers. If we buy computers, the technological change there could be pretty rapid. And so intangible assets have a little bit different element in the terms that there could be a legal or contractual life that changes. Maybe like a franchise, I've mentioned Subway restaurants. Maybe our agreement is only for 5 years to have a Subway franchise, even though the Subway franchise will continue on, for a long period of time. We have to look at the terms of our franchise agreement and understand what's the service life for us, and we have to amortize that, not depreciate it, amortize that over the service life. And so whether it's a copyright, patent, that we may purchase, we're going to have some terms in that purchase, in the right to use that patent or that copyright, and there will be a term usually expressed in some number of years, which will be, again, even then lower than the physical life of that copyright. Allocation base, which we talked about, that's the initial value of the purchase minus the residual value. The residual value amount of cash we expect to receive for the asset at the end of the service life. What we can, and there may be some disposal costs. We'll have to consider those as well. So kind of here, what method should we do here? I'm going to hide this meeting control so I can see this here. You can't see the meeting controls, but so allocation method. Now there, I'm going to go right to the bottom here. Well, let's start right here. The method, this is GAAP, okay? And these words are very important. The method that we use for cost allocation must be systematic, done in a systematic and rational manner. And so there are two allocation approaches. One is time-based, over the year. And as we can imagine, some is activity-based. So we could just expense it based on the amount of use of the asset, miles driven for a truck or units produced for a factory machine. And then in time-based, there are two there's multiple methods we'll get into, but there's two basic categories. One is the straight line. It's so easy, just allocate the same cost. If it's 5 years, do 1/5 of it every year. Don't we love the straight line? But there are accelerated methods that might depreciate more in earlier years rather than later years. So you're going to have the same expense in total over the years, but you would have more expense in the earlier years in accelerated method and less expense in later years. Why might you do that? Well, it might be for an asset we know that declines in value faster or gets used up faster in the earlier years than later years. I would say another method, another reason for accelerated methods that we're going to see later is tax deductions. And so, again, we'll talk about this, but in this case, you are allowed to use different depreciation methods for your financial reporting or for income taxes. So you'll see very many companies, all the companies I work for financial reporting, we use the easy method, the straight line method that amortizes expense equally every single year for every asset that we own. Yet for tax purposes, we use as accelerated a manner as the IRS would allow. And so that we can take big deductions in the earlier years and get tax savings faster. Again, total amount of depreciation over time is going to be the same, whether it's a straight line or an accelerated method, and really in any of these methods. And then finally, activity-based depreciation methods, we'll talk about units of production method. And so we will record depreciation expense with every unit, and however we define a unit, and we will calculate depreciation expense based on the units that the asset has been used during an accounting period. So let's look at straight line. Here's a 250,000. I think the same back pattern right here that we see here on the screen is going to be used in all the methods we're getting ready to look at, which will make it kind of interesting to compare these. And so for the facts, get these down in your head. We're going to purchase this machine for $250,000. It's going to last for 5 years, service life of 5 years. It'll last longer than 5 years. The physical life may be greater, obviously, because at the end of 5 years, that's as long as we're going to keep it for our service life, but we'll be able to sell it for $40,000. So what do we have as a cost for our business? $210,000. And so we're going to have to record expense for $210,000 over each of these 5 years. We've got to find an allocated method. And we'll get into units production. We'll look at that later. So straight line, easy. 250 minus 40,000, that's the 210,000 I just mentioned. That's the total cost is 210,000 over 5 years. And that does not change regardless of whichever method you use. So we're not going to depreciate any more than 210,000. We're not going to depreciate any less than 210,000 based on the method we use. However, as we will see, each year is going to be different. And so straight line, so easy. 210,000 divided by 5 years. So we'll have depreciation expense every single year, exactly the same, 42,000 a year. And here's the table that we'll see this again. And so think of this as, if you will, as the accounting, the journal entries, and what is the balance in accumulated depreciation on a cumulative basis each year. So in other words, I'm just trying to tell you how to think about this table. In year one, we're going to debit depreciation expense for 42,000 and credit accumulated depreciation for 42,000. What's a book value? Let's just talk about what is sometimes it's called net book value. That means the net book value is how much we paid for this, not this depreciable base. Let's go back. How much do we pay for it? 250,000. And in the accounting system, we're going to debit equipment for 250, and we're going to leave that 250 doesn't change. We're going to record this contra asset, accumulated depreciation each year. So what's the book value at the end of at any point in time? It's going to be the historical cost sitting in the equipment account, 250,000, minus the contra asset, accumulated depreciation. So after year one, we only have one journal entry we've done. And so accumulated depreciation after year one is sitting at a credit balance of 42,000. Book value, here you go, $250,000 cost minus the credit in the accumulated depreciation account, 42,000, 208,000. Year two, I'm not going to do this for every slide we see, just to let you know. I'm just trying to explain this slide so you'll see how these other slides work when we do accelerated methods and units of production. So year two, debit depreciation expense for 42,000, credit accumulated depreciation for 42,000. So now at the end of year two, how much do we have in that accumulated depreciation account? It's a balance sheet account, it's a permanent account. We don't wipe it out at the end of the period. We've got 2 years of depreciation at 42,000 each, 84,000. What's the book value? 250,000. That hasn't changed in our books, minus the contra asset credit balance of 84,000. We've got 166,000. And we do the same thing every year, same journal entry every year because it's straight line. And we end up where the accumulated depreciation account has now 5 years of depreciation expense journal entries in it, 210,000. So 42,000 times 5 equals the 210. What's our net book value? 250 minus the credit balance of 210, 40,000. Hey, I remember that 40,000 from somewhere. What is that? That's the residual value. And so we end, in all of these methods, we end up at the residual value. And so if our estimate was right in the beginning, then we'd go sell this asset for 40,000 and we, no gain or loss. We would be perfect at that point in time. So we always end in all the methods. We end with accumulated depreciation of 210 and book value of 40,000. I don't care what method is. What's going to change? The amount of expense each year. So let's go look at the next method. Double declining. I love this method. I just love math. So it's kind of interesting. Now, there's a couple of nuances here that you just have to know. But I don't care if I'm your professor or someone else. You're going to get multiple choice on straight line, double declining units. You're going to get these. And do not be intimidated. They're easy. These are like knock them dead, get it right, easy. But here's the nuance with the double declining. In year one, we ignore the residual value. In year one, we only account for the residual and even think about residual value at the very end. That's unique to this method. In all the other methods, we do consider the residual value. So look how we start here right off the front with the full 250, not 210. Now, think about this word. We like to use words in accounting that reflect what we're doing, versus straight line. This is double. Whatever your straight line method is, we're going to double it. In other words, if we go back, 1 divided by 5 would be 20%. what is 20%? What does it relate to? This 42,000 in the straight line method, go do your math if you want. If you don't believe me, that is 20% of 210, because the depreciation rate each year is 1 divided by 5. So what if we want to double that? 20% times 2, or instead of 1/5, it's 2/5, 40%, double declining balance. So we're going to take a lot bigger instead of 42,000, but it's not. Notice that it's not. The answer for the year one is going to be 100,000 of depreciation expense, but note it's not double the 42. Why? Because we start with the full cost. We ignore the residual value in the double declining balance. I don't know how many times I can say that, and I want to say it like 100 times because everybody misses this. Everybody forgets this, and you know how evil multiple choice questions are in accounting. They know you might miss this, and so there's going to be an answer there, and it's going to say 84,000. Answer B, and you're like, oh, it must be right, 84,000, because they got B says 84,000, and that's what I calculated. They are evil. They know the bad paths you can go down in the multiple choice question. Don't let them do that to you. Learn how to do it. Practice these problems. And so we take the full value of 250 times 40%. We get $100,000 of depreciation. Look at how much lower our book value is. If we go back here at the end of year one, we only had 42,000 of accumulated depreciation, book value of 208. Now we only have a book value of 150 after after we consider the first year of depreciation expense. Now notice how this works. We don't do 100,000 every year. We just do everything. We'd be done. We'd have 200,000 in the first 2 years. We only have 10,000 to go. Remember, we're not going to be more than 210,000 here. Not. So in year two, we take the book value at the end of the previous year, that 150, that is what we multiply times 40%. And for me, that makes this kind of interesting. And so now 40% times 150, it's 60,000. Again, debit depreciation expense for 60, credit accumulated depreciation for 60, and now we have 160,000 balance in there, and then $250,000 cost minus the contra asset account with the credit of 160, we've got 90,000 in the book value. Year three, that previous year's book value times 40% is 36,000, and net book value is 54,000. Now remember what I said. Every year, regardless of the depreciation method, we're going to end at 40,000. Now, if we took, let me get my calculator. If I took 54,000 over here times 40%, that would be 21,600. But we can't do that, because if I did 21,600, I would get to a larger amount than 210. And so we stop. Whatever year we hit 210, we stop. We just record whatever the remaining piece is of that 210. And this one, we did it at year 4, could be year 5. We have to plug that. And so again, we end in the same place, 40,000 at 210. But look at, this is a really good, look at the accelerated method. Because we did 100, and then 60, then 36, and 14. Same 210, but almost all of it is booked in the first 2 years. Most of it, 80% of it, I guess, something like that, is 160,000 in the first 2 years. And in the previous method, first 2 years, we only did 84,000. So, a lot more depreciation in those first 2 years. Here's another interesting kind of, I like it because the math in here is called sum of the years digit. So if I take 5 plus 4 plus 3 plus 2 plus 1, that equals 15. And so then I do 5/15, 4/15, 3/15, 2/15, and 1/15. Now I still get the 15 or 15. I still get the 210,000, And I just record, again, here, some of the year's digit, we do include the residual value. So it's only the double declining balance that ignores the residual value. There are other methods that do ignore residual value, but we're not going to talk about that. We won't talk about this one here. I'm not going to test you on those. And so here, some of the year's digit still accelerated. We're doing a lot more in the first year than the last year, but we still get to the same place in total, 210. 250 minus 210, net book value, end of year 5, 40,000. Get to the same place, same amount of total depreciation, but there's more depreciation expense in the early years. Bigger tax deductions. So the tax department likes these kind of accelerated methods, and they're going to use them, you know. And while we're sitting over there in the accounting department doing maybe a straight line, something different. So now let's look at units. I think the activity-based depreciation method has got to be the best method that provides, it's the most direct method that's recording the actual usage, the expense for the actual uses of a vehicle or a machine or whatever you're using. The only thing in the real world that's hard is trying to go measure that activity. I know that all the big steel stamping machines at Maytag and Lennox, they kept counters. So every time that machine came down, there was a counter. And think about these really large factories. I'm talking about big factories over acres and acres of land. And one of there maybe a couple hundred machines in there, and the counters are working. That means that someone's got to go out there and look at the counter on every single one of these machines. Even if we could do it electronically, we're still gonna have to go do a spreadsheet or something. So measuring the activity is a lot harder. What if you have salesmen out with cars out in the field? You got to call all those salesmen all over the country, maybe all over the world if you're global, and say, what's the mileage on your car right now? You know, you got to trust them to tell you the right answer, because not that they would do it fraudulently, but they may not, oh my God, the accounting department's calling me, I'm not going to give them a number, I'll just throw something out there. You don't know how accurate it'd be. So that's my only kind of comment on activity-based depreciation in the real world. It's actually a lot harder to go measure this stuff. But theoretically, it is such an awesome method because you're measuring actual expense. So let's look at that. And so this machine, we believe we're going to produce over the service life. The service life is not years anymore. It's 140,000 units. I mean, it's 5 years, but we're going to produce, 140,000. Now, if we looked at actual, we end up doing 150,000, because we're not going to estimate that correctly. So what do? Get back. So we're going to look at the depreciation cost, per production unit. So we're going to produce 140,000 units. So that's our denominator. What's our cost? Look, we account for the residual value in this method. Because, again, double declining is unique in that aspect. So 250 minus 40, we've got a $210,000 in cost divided by 140,000 units. So each unit that we produce, we're going to expense $1.50. Pretty easy. So right off the bat, here we produce 20,000 units times $1.50, $30,000 in expense. There's our, $30,000 accumulated depreciation. There's our net book value. Next year, 32,000 times $1.50. So each year we get there. Now, just note that in reality, this machine produced 150,000 units, not 140,000 units. And so in the last year, we have to cap that. Because why? We cannot depreciate more than our original cost of 210, because that was our real cost. And so we have to, just like the double declining method, at some point, we got to stop and plug the number, because our original estimates on total units produced was wrong. And so we'll still we have to end up at 210,000 of total depreciation in the accumulated depreciation account and a net book value of 40, because that was our estimated residual value. Unless that's changed, that's where we have to end. And you see here a really nice chart that shows here's straight line, 42, 42, 42, easy, double declining, really accelerated in the early years. Some of the year digits still accelerated more than 42 in the first year, less than 42 in years 3 and 4. Look at that, equal in the third year. In units of production, it just is what it is, because it's based on, it's not accelerated method. It's just based on how much you produce. So it's a little bit more of a volatile number, it's changing each year, but it's directly correlated to the use of that machine. And so that's a good thing. So I do like that method. All right, so how do we select the method? Straight line is easy. That's why in all my companies, I know that we use a straight line. And none of my operational managers would have liked the accelerated method, because they would have had more expense in their budgets in the earlier years. They don't like that. If they could, they would do a decelerated method, but we don't have that. So straight line results in a positive net income versus accelerated in the early years because less expense. Now, accelerated methods result in more depreciation in earlier years, as we talked about. And why do we like that? The tax department likes it. Bigger tax deductions. And then, unlike the LIFO rule that you have to be the same for financial reporting and tax, here you do not. So you could use different depreciation methods for tax versus financial reporting. Yes, activity-based depreciation provides a better match of revenues and expenses. That's what I've been saying. However, a little harder to go measure that activity. Now, one thing you want to think about is, guess what? We don't buy all these assets, I wish we did sometimes, on January 1, and then we have a full year. We buy them partially through the year. And so we got to think about maybe recording just 1/3 of a year of expense, or 9 months of a year. There is what's called a half-year convention, where regardless of when we buy all of our assets, we do everything during that first year as a half year. And it's a shortcut that is, a half-year convention that many companies do. And, and I doubt the difference would be material, because you probably buy all these assets throughout the year. Now, I know for public companies, I remember my auditors, they're going to challenge me if I buy some really big asset early in the year, really big material asset, and I'm just going to use a half-year convention. And they might come back and say, no, you got to do the 9 months or 10 months. So I will just add that out there. But, good to know the half-year convention as a student, because many companies will use that. So this is an example of the, we're going to look at the half year. This is the same answers we had before. I'm skipping by that. So here, in this case, 42,000, we used it for 3/4 of the year. So we'll book 31,500 this year. But look, in the last year, we'll still have 5 years, but in the last year, just 1/4. And we'll do the same thing, whatever our expense would have been, we'll do 3/4 this year. But look, here we plug in the last year, so there's no 1/4. And so units of production, it is what it is, because if you only had it half the year, you probably use it for, less units that year. And so that doesn't matter. So now we move on to dispositions, when we sell or get rid of our asset. And so, we're going to have to most likely record a gain or loss. Why? Boy, let's just go back to the example here from the textbook. We are going to try to guesstimate for a 5-year asset what we're going to be able to sell it for in 5 years. Nobody is going to get that right to the last penny. Nobody. And there could be, significant differences of what we sell it for. And so if we sell it for more than our book value, by the way, we're going to have a gain. If we sell it for less than our book value, we're going to have a loss. How do you calculate that? You go look at your selling price. You go calculate your net book value, which is what? The original cost, still sitting in the account at the original cost, minus the contra asset accumulated depreciation for that particular asset. I get my net book value and I compare it to the selling price, and then I have a gain or loss. Here's an example of a company that they are using straight line, I believe. Depreciation expense $42,000 a year, and after 3 years, they've got $126,000 in their accumulated depreciation. Again, I think this is the same example we used, the 250 minus 40. So this is really the same example. But on December 23rd, in the end of the third year, let me say that, and I'm trying to say the whole date here, we sell it for $140,000. So did we have a gain or loss? Well, let's go do the math. We sell it for 140 and the net book value is only 124. Hey, gain. I hope that makes sense to you. If our net book value is X, if we sell it for more than X, gain on sell. If we sell it for less than X, loss on sell. In the journal entry, by the way, if it's a gain, guess what? Credit. If it's a loss, debit. But when you do the journal entry, whatever plug you need here, you'll know, because you know I got 140,000 in cash, right? I'm going to eliminate this asset from my books. So I'm going to go credit that machine account because it had a $250,000 debt balance and it had a 126,000 credit balance accumulated depreciation. I'm going to debit that and take it to zero. Then what's my difference? What's my plug? 16,000. It's really another way to calculate a gain or loss or check your math here, because you can go do these three that you know in the facts. And if you need a debit, you got a loss. If you need a credit, like this example, you have a gain. Again, all that I've just said, a gain on the sell is when we sell it for more than its book value. A loss significant that it's less than the book value. Okay, now every now and then we're going to decide, and these are usually significant type assets we're going to talk about here. There's a minor asset you might not care as much, but if it's got significant dollars, we may decide, hey, we're going to sell this, and we will be able to put it in a special category on the balance sheet called assets held for sale. That's different than assets in use. We're holding this asset for sale. Now, what's very interesting about this? You stop depreciating it because you're not using it. You're holding it to sell. So the FASB and GAAP has some hurdles, because everybody will want to put things in assets held for sale and stop depreciating it, so could be certainly open for fraud, so there's some hurdles you got to do. You got to be able to meet all 6 of these. And I've been involved in analysis in an asset the company wants to sell, to make sure that we've got a commitment to sell the plan. The asset is ready to be sold right now, wherever it is and what condition it's in. And we have an active plan. We're actively trying to sell it. We're looking for a buyer. This is a hard one sometimes. The completed the sale of the asset is probable and will happen in a year. Well, so now we're predicting the future here. And if it's an asset we don't like and we're holding it for sale, it may not be probable it can sell. So this is a hurdle that you have maybe a hard time convincing yourself and your auditor that it's probable it's going to sell. And number 5, are we selling it at a reasonable price that it would sell? And then we're fully committed, in number 6 here, that we're not going to change our minds about this, that we're going to sell it. So once you meet all of these 6 requirements, you could put an asset in the asset held for sale category. It's going to go in current assets because it's going to be sold within 1 year. Come back to me. It's going to be sold with 1 year, and we don't depreciate it any longer. So that's just an interesting kind of classification. Now you may say, hey, I can't sell this asset. I'm going to retire it or dispose of it, whatever. And then we just take a loss on whatever the remaining net book value. We do that last journal entry without any cash, the one where we sold the asset for 140,000. Now we have no cash in there because we're just getting rid of it. So we get rid of the accumulated depreciation with the debit, get rid of the asset value with the credit, and then the remainder definitely going to be a loss on that, so Moving on, now we get to talk about one of our favorite subjects here in Texas, depletion of natural resources. And so here, activity-based units of production method is widely used, and because natural resources directly related to what we extract here in Texas out of the ground, oil, natural gas, but it could be timber, other natural resources like up in Maine. I've talked about that in previous lectures. There are other resources that could be extracted. And so, here you should know depletion base, that's like the allocation base, cost minus the residual value. So depletion per unit is the depletion base, this total cost, divided by what we estimate is extractable units. And so for oil and gas company, this almost like a nightmare, seems like to me. You got to have geological surveys and experts weigh in on how many, gallons of crude oil is under the ground. How much is there? I guarantee you one thing: it's not an accountant. Maybe there are accountants, but they're going to have some other expertise. A scientist, more like, who's an expert of what might be under the ground that they're drilling out of the ground. And so it's, again, this depletion per unit, like units of production that we did earlier in this lecture, it's just going to be how much depletion expense did we record. We just take that depletion rate per unit times the units extracted. So debit depletion expense, and then we don't have a contra account here. We just credit that natural resource, whatever it might be. Here's an example for a coal company in Pennsylvania. So if you're watching this from Pennsylvania, you might know this. And so here's the actual, all of the costs that we included. Hey, look at this, restoration of the land. That's an asset retirement obligation. Remember that guy? 468. It looks like the same number we used from the last chapter. So the total costs are 2,768,000. And so how many tons of coal do we think that are there? 1 million. And so we take the 2,768 cost, which includes that asset retirement obligation, love that thing, divided by that 1 million tons we estimate that's under the ground in coal. This could be $2.76836 per ton. And each year we multiply it times, here 300,000 tons were extracted in 2021. We take that 300 times our depletion per rate, this is per ton here, and we debit expense and we credit that natural resource. So that 2,768 debit balance now comes down by 830,000. And every year, by the way, we are still going out, after we have a year under our belt here, we'll go see, hey, does that 1 million tons still right? So there could be a change in estimate here. We'll look at change in estimates later in the chapter, but change in estimates, remember, our prospective, that we're, accounting, and we change years going forward. Remember, retrospective, we have error, we go backwards. So just keep that in mind. All right. So for now, we're moving to intangible assets. Remember that we call this amortization expense. So we have depreciation expense for property, plant, and equipment, and depletion expense for natural resources, and amortization expense for intangible assets. So again, very similar to the service life, we got to look at the useful life of each of these intangible assets. It'll be pretty clear based on the contractual arrangement, estimates around that. Now, residual value, intangible assets, they don't usually have, they just go to zero. If there's some way you could sell it at the end, I don't know. I think mostly I've seen just zero for the intangible asset. And then we'll look at the method of amortization, reflects the pattern of usage there, which would be very similar to depreciation. So here's a franchise that we purchased for $200,000. And the franchise agreement is for 10 years. Now, maybe that franchise could continue past 10 years and have value past 10 years, but we purchased it for a 10-year contract. So we're going to expense that. We're going to amortize that over 10 years. 200,000 divided by 10, 20,000. Here's a patent. The remaining legal life of the patent is 13 years. However, we don't think that that it's due to a lot of technological obsolescence in whatever industry this is in. I don't know if it gives us that. We think it's only going to last for 8 years, and so we would take that 50,000 divided by 8 years. Obviously, estimating these useful lives and service lives very important, and you'll see companies have to change that over time. Okay, another intangible asset that is unique and is just problematic. I've had so much pain in my career over software development costs. And so now this amortization, I've usually seen more straight line, but I assume that you could also use the percentage of revenue method. I've not seen that in practice, as much. Intangible assets, okay, we talked about this in a previous chapter. Some intangible assets, they don't get amortized. Why? We believe they have an indefinite useful life that, nearly permanent. We don't say the word permanent because nothing is intangible is purely permanent for 1,000 years or something, but indefinite. I mean, we see no end to this asset. And a lot of times a trademark, like the Apple trademark, that little apple with the bite out of it, man, what's the life of that? Right now, it looks like it's forever. Now, it's probably not forever, but it's certainly an indefinite useful life for that Apple trademark, that Apple. And they don't, in their stores, they don't put Apple Store. They just put the Apple up there, and everybody knows, oh, it's an Apple Store. I think they're usually silver in those stores. I love going into the Apple stores, like a big toy store, toy store for adults, I guess. And so they've certainly trapped me in for sure with their brands and that. So, and it says here, indefinite does not mean permanent, which, as I said. Now, guess what? No amortization for these. However, as we're going to see later, we do test them for impairment to see if they still have value, and we may have to take a charge if we consider them impaired, and we'll look at that. Change in an estimate, clearly for my students, we'll see this in multiple choice questions, and what kind of changes can happen with property, plant, and equipment? A lot of them. Residual value could change. The service life could change. As we start using the asset, we start realizing, oh man, either it's going to last longer or it's not going to last as long. We've got a change here. And so here's an example of how we handle that on a prospective basis. And so in this case, the same 250 using the same. I love it the way. That's why I like having the physical, like students have the physical textbook. You're going to follow this through in the textbook, and you have the same facts. You don't have to get your mind around a new set of facts. Here's that 250 residual value of 40. Same example we saw before, but guess what? At the end of 2020, this is 2 years time. To 2019 and 2020 January. We're looking at it, and guess what? Wow, this is good news. It's going to go from 5 years to 8 years. This thing, man, it's rocking and rolling. I believe I can use this a lot longer. I didn't know, I thought it was only going to be 5 years, but the operational managers, the machine's in great condition. We're going to keep that thing for 8 years. Maybe a new strategy to keep things longer. But guess what? If you keep it 8 years, you're not selling it for 40,000 anymore. That residual value goes to 22. So how do we handle this? We go look at the net book value. And so here's that net book value on our books at 1/1/21, the $250,000 cost minus the 2 years of depreciation on the straight line. Remember, it was 42,000 each year. So we got 84,000. So our net book value is 166. Now, so we got to look at this prospectively. We leave the depreciation alone for 2019, 2020. We don't change this. We don't go retrospectively and change the financial statements. We just change it going forward. How do we do that? It's almost like we just bought the asset for the first time. We look at this net book value times the residual value, and we say, here's our new depreciation base, 144. How many years do we have left? Well, guess what? It went from 5 years to 8 years. And so we originally thought we only had, at the end of 2 years, we would have thought we only had 3 years to go for the 5-year. Now we're at the end of 2 years, but we've got 6 more years to go to an 8-year life. So we divide it by 6, and it's now $24,000 a year for years 3 through 8. Year 3, year 4, year 5, year 6, year 7, year 8. And so, and we're going to record going forward $24,000 of expense. We leave the $42,000 in 2019 and 2020 alone, because this is a prospective method. Now, keep in mind, it's a change in estimate versus an error. If you have an error somehow in the way you calculate depreciation expense or something, you would have to go back and do the retrospective method. You have to go back and restate those prior financial statements. So a change in estimate is different, handled different than an error. But I want you to remember those, change in estimate, prospective, change things going forward, leave the past alone. Error, change the past, and change it going forward both, so you have to, that's called the retrospective method. Now we get into a subject that, again, oh man, I've had more pain over impairment charges. When I say charge, that means an expense. Nobody likes an impairment charge for an asset. We'll get into goodwill impairment. It is so painful. And unfortunately, usually a lot of times the chief accounting officer, corporate controller, that was what my position was, you are all by yourself, saying, hey, this asset's impaired. And nobody else is going to agree with you. And you'll see why in a minute, because everybody's going to predict the future differently. And operational managers, they don't want impairment charges. That means they did something bad, or they bought the wrong asset. There's, nothing is good for an operational manager when you start talking about impairment. And that's why we have to have really good procedures and processes as companies, especially public companies, to make sure we're evaluating all of our assets, property, plant, and equipment, intangible assets, and goodwill, for impairment. And each one of those, as we can see here, is different. So here's an example where a building is destroyed by fire before it's fully depreciated. Well, we're going to have to write off the rest of that asset as a loss. And, we're going to have to record that as an impairment charge. So let's talk about impairment of value for assets held and used. And they should be written down as a significant impairment of value. And here's Murphy Oil recorded impairment charge of 95 million, reflected in, in what? Hey, oil and gas prices decline. So the value of that oil and gas under the ground is not worth what it was when we bought it. And so they're going to have to take a charge. So there are different guidelines. Really, there's 3 different guidelines. One, for property, plant, and equipment, and intangible assets with finite useful lives. There's a different method to evaluate impairment than indefinite lives that are not subject to amortization. So there's 2 different impairment guidelines, and we see with goodwill, there's actually a third one. And so we'll look at that here. Let's start with the first one. And these are assets that are subject to depreciation or amortization, property, plant, and equipment. and finite lived intangible assets. These are the ones. And so when do we test for impairment? Only if events or changes in survey indicate that the book value of the asset may not be recoverable. And so something's happened. You don't go have to test. It'd be just so freaking hard to go test every single asset around the business for impairment. It'd be nearly impossible. But we have to know when circumstances have changed, and that maybe in the environment, maybe we have a product that's not selling, or something has happened so that piece of machinery, maybe there's obsolescence out there, and the product that we're producing off of a certain machine is not selling very well. Then we got to go look at that machine. Is it impaired? So something has happened. There's been a triggering event around either a single asset, or it could be a group of assets. Sometimes I've done whole factories, right, that are producing a classification of products. Is that whole factory impaired? So we have to group it. We are required to group at the lowest level where that has identifiable cash flows. So it may be almost impossible to identify a cash flow for one of the stamping machines, one piece of equipment out in the factory. So we have to group them into assets for a certain product line, or maybe an entire factory. So we're going to be looking at future cash flows. So the assets have to be connected to a level of cash flows. So here's some events or changes in circumstance that indicate an asset might be impaired. By the way, I'll go through these, but we sent a checklist that included all of these items to each of our factory controllers and our business unit controllers all over the world, in both Maytag and at Lennox. And they had to come back and say, I don't have any assets where any of these have happened. But generally they would come back with a few assets where it met one of these requirements here. And we had to call that person, spend some time with them and talk about it. So has there been a significant decrease in the market price for the product produced by the asset? Is there a significant change in how the asset's being used, or its physical condition? I know for Lennox, a tornado hit the Marshalltown factory and destroyed a whole bunch of assets, right? And that would be an adverse change for sure. Has there been a change in the legal factors? Maybe we have to produce by law more efficient products, and some of this machinery doesn't help us to get to those efficiency levels. Are there costs higher than was expected? Current period loss, or hey, I just realized this asset is going to be disposed of significantly before the end of its useful life. So anytime you have one of these conditions triggered, then you need to go do what we call an asset impairment test. Now, again, this is different than what we'll do for indefinite life intangibles and for Goodwill. So keep in mind, this is a different process, because we have a step one recoverability test. And that again is only for property, plant, and equipment and finite lived intangibles. Keep that in mind. So in impairment one, we look, and I don't know how the FASB got to this rule. It's kind of it seems funky to me, but we look at the undiscounted future cash flows. By the way, fair value would be discounted cash flows. What do I mean by undiscounted or discounted cash flows? Remember, time value of money. Money today is more valuable than money in the future. So money in the future, I'd have to discount that back based on interest. And so, if we had a 10% interest rate, $1 today or $1.10 in the future would be the same. Here, we don't discount that $1.10 back to $1 in step one. We just go, no time value money considered, undiscounted sum of future cash flows. If that is greater than the net book value, we stop. We call it, we've recovered the asset in future cash flows. Imagine the arguments you could get into if let's say me as the corporate controller said, hey, I think this asset's impaired because I think the future cash flows, they've been declining the last few years. I think they're going to continue to decline. They're going to be long. And some, great operational manager, and they're great operational managers. Why? Because they're optimists. They believe, oh yeah, Roy, it's been going down, but guess what? I got all these plans, strategic plans. We're going to have significant, I call that hockey stick, like here, and then a hockey stick cash flow forecasts. And so really a challenge here to forecast the future, because who knows whether I was right or the operational manager is right. That's just a crazy challenge. And how do you audit that as an auditor? So that becomes a challenge when you start talking about future cash flows. Now, if the asset is not recovered, future cash flows are going to be less than the net book value. Then we go look at the fair value. And if the fair value is less than the book value, then you record an impairment charge, and you what we call write that asset down. And so there will be debit impairment charge, credit the asset. So the asset value, total assets are coming down, and you're going to record an expense for that. Now, just think about it for a minute, because step one, the undiscounted cash flows are going to give you one number, and the undiscounted cash flows, well, guess what? The discounted cash flows are always lower than that, and mostly fair values are determined based on the discounted cash flows, because you may not have apples to apples comparison to those products. And so once you recognize that impairment loss, the new book value of the asset, which is going to be lower, becomes a new cost base for future depreciation and allocation. So how do you determine the fair value? The fair value is what the asset could be bought or sold for in a current transaction. Well, that may be hard. Who's going to buy a group of machines out in the factory? And you can estimate it if you can't determine it from that. And so guess what you normally use, which I've used many, many times, is just discount the future cash flows at an interest rate that's based on the risk. And so even determining the discount rate can become a challenge. So as I've said, undiscounted cash flows, they determine if there's an impairment loss. But once you determine there's an impairment loss, the discounted cash flows are going to estimate the fair value, and that'll give you the amount of the loss. So is it impaired? Look at the undiscounted cash flows. How much to impair it? Look at the discounted cash flows and the fair value. And you are going to have to disclose that all the facts and circumstances around that impairment charge. Now, second category, indefinite lived intangible asset, other than goodwill. So goodwill has a whole nother separate div. So indefinite lived intangible assets are tested for impairment annually, minimum, but you could do it more than annual if something has happened in the circumstance that said, hey, this thing might be impaired. And this is only a one-step process. So you immediately look at the fair value. If it's less than the book value, you record an impairment loss. There is no recoverability test for indefinite life. So everything's the same, except there's no recoverability test. Now, goodwill has its own set of challenges because it's unique. It's not, goodwill is, again, only happens when a company buys another company. And it's the excess, as we remember from the last chapter, of the fair value, that the purchase price you paid for another company minus the fair value of the individual assets and liabilities. So it's not related to any asset at all. So you can't look at an asset and say, hey, what's the fair value of this asset? And so you have to go look at the value of that business, that the goodwill is associated with. And the level of testing is a reporting unit. So this is a definition in GAAP. What is a reporting unit? Is an operating segment of a company or a component of an operating segment that is a business. Let's just say, what is a business? It has discrete financial information available, and the segment management team reviews the results of that component. So you go to the lowest level assigned, which would be the component operating. If you can't go there, then you would come up into the operating segment. So this is a definition in GAAP that becomes important sometimes. So we do the same thing. We compare the value of the reporting unit with the book value. You know, if the fair value of the reporting unit is less than its book value, an impairment loss is indicated. How much will the impairment loss be? Well, it cannot be greater than goodwill, because we're testing goodwill. And so lots of, you know what I say, a lot of words on this page. Let's see, we're gonna do an example here. I think it would make it better sense. I think so Upjane purchased Pharmacopoeia for 500 million and recorded 100 million in goodwill, because the net assets were calculated out, you know, analyzed, and appraisals were done. There were 400 million. So we got 100 million. Sorry about that. Stop doing that, please. You know, I got to talk to myself here. So, but now we find out, we're going to go test goodwill. If we find the value is net assets at the end of 2021, including the 100 million. This is the book value of the assets, not the fair value. It's 440 million. However, the fair value, and we're going to go evaluate that business and calculate the fair value. Many times, the best way to do it is to hire an independent appraisal firm, and that can value a business. These are, you know, big time firms. That's what they do. And hopefully this company did that. And they came back with this company's only worth 360. Okay, 360 is less than the 440. All right. The impairment charge of 80 million. Again, we can do 80 million because the goodwill is 100 million. Now we can, if that number said 120, we got to stop. We can only, you know, we can't write off more than exists in the goodwill. So we're trying, this is an impairment loss test on goodwill. And so, so that 100 million now, guess what? It's going to become 20 million. We're going to credit goodwill for 80 million and debit a loss and impairment of, you know, 80 million. Yeah, when you look at goodwill impairment charges, they are large, always large. And I remember recording a $50 million charge for one of our business units. It was so painful. I didn't even talk about it. You know, I had to have, you know, one thing, sometimes when you're an accountant, it takes courage. You have to have courage to be able to get to the right answer. And, you know, that's tough. That can be tough when you're talking to your CEO and CFO about it. You know, we're going to take a $50 million charge. They are never, I don't know, any CFO, CEOs could be happy about that. No, never. And so it takes courage to do that. And you can't hide behind your auditors would be my one guidance. It has to be, you know, here's my answer because I have integrity. And then, you know, the auditors are there too. If I didn't come up, the auditors would come up with it and they say, hey, where are you, Roy? You know, so now assets to be sold, you know, again, you know, that's in that assets held for sale. The only difference here in assets held for sale, we're going to take the fair value less the cost to sell. So there's a little bit of a different element here for impairing assets to be sold versus assets being used. That's why they had that clarification in the previous slide. And so it's a fair value less the cost to sell. Why? Because we know we're going to sell these. And so we have to find out what that cost to sell is. And here's one slide. I'm sure it's in your textbook, whatever textbook you're using will have this. And it just talks about, so property, plant, and equipment, and finite life, there's two steps: a recoverability on undiscounted cash flows, and then a loss if the fair value is less. Indefinite lives, other than goodwill, we do not have a test for recovery. We just look straight to the fair value less the book value. And how often do we do that? At least annually. Goodwill also at least annually. For property, plant, and equipment, we only do that when circumstances, there's a triggering event. We are required, at least annually, to test for impairment for indefinite life intangibles in Goodwill. It's a significant and process. It takes time, and so you have to plan ahead for that. So for Goodwill, same thing. We look at the fair value of a reporting unit versus its Goodwill, and we recognize the loss for the difference. However, cannot be larger than Goodwill. Held for sale, fair value minus the cost to sell. That's the only, there's a nuance there. Yeah, unfortunately, a lot of nuances here. And maybe what's good now, pause the video and spend some time on this slide. That would be a good idea now. In fact, I'll just pause and take a drink of water while you think about that. So now we're going to move into other things. This whole chapter is about things that happen after you acquire an asset. So guess what? We're going to be spending money for these assets. They're long-lived assets. And there's really two types of spending. There's one that's just maintenance, keeping that thing going. The best analogy is your car. Got to change oil. If you don't change oil, your car is going to die. Guarantee. So you got to change the oil, maybe change the spark plugs. That's what we call maintenance. And so maintenance gets expense. However, if you do something significant to an asset that increases its book value, almost creates like a new asset, then you could capitalize that cost. If I use the same car analogy, maybe replacing the engine. I did have a vehicle personally, these are businesses we're talking about, but I had to replace an engine at 100,000 miles, but I just love the car. I still own the car. And it was a $20,000 cost to put a new engine in that car, but I loved it. And I spent that $20,000. And by the way, I expect it is going to, what do they say? It produced benefits, beyond, that the useful life of this asset is going to continue, for another 5 years for that $20,000. So you capitalize those costs that, extend the useful life of an asset. Beyond just extending the useful life, maybe you improve the operating efficiency. You've done something that really significantly changes this asset to make it better. And there's, quantifiable future benefits. Then I can capitalize. That means I can debit an asset. Repairs and maintenance do not provide future benefits. They just keep this thing ongoing. There are future benefits, but they're not beyond what we originally anticipated. And so they use a tune-up, repair of an engine, oil changes. That's just maintenance. Repairs and maintenance expense. I would like you to think more in terms of extending the useful life, that it had a 5-year life like my car, and now it's got a 10-year life. I hope even more than that. You could add something onto your asset, like adding a refrigeration unit to the delivery truck. That's going to just change the whole capability of the truck. And so therefore I can see how that could be capitalized versus expense right away. Now, I've been involved in a lot of rearrangements in both of the corporations I work for. We had a strong focus on lean manufacturing, and seemed like we're always rearranging the factory machines to make the operations more efficient. And so if the rearrangement is going to have benefits beyond the year, then we can also capitalize those. If they're material, if there are future benefits, so we could capitalize the cost for a rearrangement. If they're not material, or we're not really sure about what the future benefits are, we would expense those. I think a lot of the rearrangements that we did were expensed, just to be conservative, most likely. Another thing that you see with intangible assets, sometimes we have to fight and sue people, maybe using our patent. And so if we're trying to, or someone uses our copyright, whatever, any intangible asset, if we have litigation costs to be, that we've got to defend and we're successful, we can capitalize those costs. If we're unsuccessful in defending it, then those litigation costs get expensed. And the last, I'm gonna go through this pretty fast. Just wanted to highlight MACRS. It's a tax depreciation model. It's a super accelerated model. I just want to touch base so you know that it exists. It is only used for tax purposes, and there's schedules that tell you how to expense it. And there's again different categories. They kind of the IRS regs tell you what category to put different types of products in, and it's a tax depreciation for income tax purpose, not used for financial reporting. And it does say, and I don't know a lot about MACRS, but I'm not a tax person, that useful lives and usability are not used. And there's various and sundry methods under MACRS that you could use, and happier convention is used. Again, that's determined by tax regulations, and the tax regulations are different than financial reporting, because in financial reporting, we're trying to reflect, have faithful representation and relevance with our financial statements. Tax rules come from Congress wanting to motivate certain behaviors, and they may want people to do more investing in their business, and especially U.S. businesses. And they will allow then, more accelerated depreciation methods. So you see more about that. And so again, not a tax person, but I do want to just highlight that there are different tax methods based on law, based on IRS regulation, laws passed by Congress with motivation to improve our economy. And so you'll see various and sundry capitalization, depreciation methods allowed by Congress. So there we go, the end of chapter 11. That was I know a long one, there's a lot to cover there. And not only is this the end of chapter 11, this is the end of Intermediate Accounting 1 at University of North Texas. So again, really thank you for hanging out with me today and listening to this lecture. And I just wish you all the best. Thank you.